Hey, everybody, we are back. The election is over. The Fed is meeting as we're recording this. I'm back with Tyler Crow, who is joining me today after a few weeks away. I thought Tyler didn't like me anymore because I talked about Dreamfinders homes too often, but here he is. Tyler,
I had to
welcome
give up
back.
for a while. I had to walk away. I couldn't take it
Yeah, he
anymore.
just had to leave. I mentioned Dreamfinders and what's the other that yeah, Nextdoor and EPR and those too many times. Um, but here we are. Um, And if you want Tyler to leave the room, just say the word stock based compensation. He will run out the door if you ever see him in person and you want to get rid of him. But we are back. We're going to talk about some stocks that we like right now. The market moves after the election were interesting. So before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel for the top 10 stocks to buy from the Motley Fool. It's the best way to support this work we're doing on YouTube. Again, the link is fool.com/Frankel. So just to kind of recap, the day after the election results were announced, the Dow Jones rocketed 1,500 points higher to the highest level ever. The S&P and the Nasdaq were up big as well, and the Russell 2000 was up, I think, 4 or 5%. It was the best performer of the big indices. Um, Small cap stocks tend to benefit from looser regulation and things to that effect. But there were some areas of the stock market that didn't do too well after the election. Pretty much anything sensitive to interest rates, anything sensitive to environmental regulations, things like that. So, with that in mind, we have a couple uh, stock ideas on our mind. Tyler, what are you watching after the kind of turbulence we saw earlier this week?
The one I've been watching for a little while. It's a company I've owned for a long time, and I don't want to call it necessarily a buy on the dip because I think it's pretty fairly valued right now. But I was very interested to see First Solar take as big a hit as it is. It's a solar panel manufacturer, as kind of the name implies, which for various reasons, thinking that maybe tax credits for renewable energy will be a little harder to come by. But here's the thing that kind of like I would say puts a lot of that concern for me at ease is right now with its current backlog of orders, like from all the people that have requested orders over the next several years. Its current backlog means it could not take a single order until after 2030, and all of its facilities could keep running at full capacity. So you have 6 years of orders already built up. That's like a presidential term and a half in terms of like longevity of how long things can go. So I think there's enough built up kind of stability in its revenue and its like production capacity that it really doesn't matter that much who's in charge or not. Maybe pricing and margins could get a hit a little bit different, but either way, like a very stable revenue base or production base to go for a long time. It has some really new, interesting tech coming on the horizon that would be a huge jump in efficiency. Big jumps in efficiency mean better pricing because you can get more power per panel installed, which means you don't have to install as many panels. All of a sudden, you can probably start to see some big jumps in profit margins from things like that as well. On top of that, its balance sheet, it has way more cash than it does debt. I think as of the most recent quarter, it had about $1.3 billion net cash position, meaning, more cash than debt total. And they lowered guidance ever so slightly in the quarter for some new investments that they're taking, and they're transitioning to a newer solar panel. So they're kind of trying to clear inventories on some older models, might get a little bit lower pricing, but these are kind of like quarter to quarter things that I don't think are a huge problem. And then on top of that, it just is about to complete two major new facilities that are about to come online. It's going to significantly increase production capacity, and it's been spending a lot of money recently. So its cash generation has been kind of thin as a result of that. But once those things come online, you go from something that is an unproductive cash burning asset to a productive cash asset. I think once those two facilities go online, the one in Alabama just went online, and the one in Louisiana, I think, is the first half of 2025. I think with all these things combined, as First Solar looks very attractive with its future prospects. And, like I said, at current value looks pretty good. Not the cheapest stock in the world, but I think after what we've seen, I think maybe people are throwing the baby out with the bathwater.
At the risk of making Tyler run away again, I'm going to talk about one of my favorite home builders. But home builders in general look like a really interesting opportunity right now. And I won't focus primarily on the one I like. Um, this is kind of like a you know a big kind of broad based opportunity. So home builders were one of the surprises that, in my mind, that got hit after the election. And the reason was due to the spike in interest rates. Interest rates kind of, mortgage rates rose like 30 basis points overnight or something like that after the election. Mortgage rates generally follow the 10-year treasury, more or less, and that spiked overnight. I see this as temporary weakness. To be fair, some home builders have reported mixed results for the quarter. Sales weren't quite as strong as people thought they would be in the third quarter. My favorite is Dream Finders Homes, as everybody knows, but you can say a lot of these same things. I know DR Horton was in the same basket. They kicked off home builder earnings season, so this is not unique. It's just the one that I'm most familiar with. But they did miss expectations in the third quarter. Home building revenue was up 10%, but that was lighter than expected. The number of net new orders was up by 10%. Closings were only up by 5% year over year, and there was an acquisition in there, so it's not as great as it looks. The backlog of homes on their books declined significantly, and margins were under pressure, which was the real reason that investors were kind of disappointed. But again, they're not unique in that. They're just my favorite company in the space right now. But there's still a lot to like about home builders going forward. Yes, margins were under pressure a little bit as rates fall. It should be a positive catalyst for home builders in a lot of ways, especially if home prices hold up as they have. Um, Really, it's home prices have risen to the point where, as Tyler has put it before, it it's hard not to make money as a home builder right now. It really is. So I don't see that changing anytime soon. I think it's still going to be a great environment for home builders as mortgage rates come down. There will be more existing homes coming onto the market if rates come down, but there's still a lot of room for new homes to kind of help solve the housing problem. There's literally over 1 million people who want single family homes and would buy them if the environment was better. And I think especially the entry level and first move up homes, which are Dream Finders bread and butter, I think that's going to be a big part of the solution. And I think that this is kind of a temporary dip that could be taken advantage of after, while the election noise is still in the air. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.